Not all debt is equal. No, not all debt is equal. Who wrote that, Jeff? Animal Farm, George Orwell. Okay. Not all debt is equal. Some debt is more equal than others. And what I'm talking about here is the US Treasury bill. It has a special place in the monetary order, and we're going to let Jeff Snider explain it to us. We're going to go over two articles. The first one, Jeff, is called Treasury Auctions Are Anything But Sorry because They've Never Been Sorry About Solly. This is great. For the audience that hasn't heard this story, I first heard this on your 7-part series with Eric Townsend, Eurodollar University on Macro Voices. I love this story. We're gonna find out who Solly is, but first let's talk about auctions and how is the US Treasury debt sold to the public?
Well, it's sold to the public through intermediaries, and I think that's really a key point to understand that there's, the government wants to sell the debt to anybody who will buy it, but yet we have to have these primary dealers in place to undertake some of the risks of, the government selling that debt so that it can be over time sold off to the public in a very orderly fashion. And that's really the point here, is the government doesn't want to have to sell its debt and worry about whether or not it can. You can't have this disruption in government bond auctions because the government would never be able to dependably borrow what it needs to borrow, which I can already, the bond vigilantes are saying, yeah, good, that's the way it should be. And they're right to a certain extent, but you don't want to have the federal government or any government show up at it. And it's not just governments, mortgage bond auctions, corporate bonds, anything in the primary market. You want to have these the ability to raise credit. They want that to go smoothly and efficiently as possible. And for that to happen, we have what used to be called anyway, commercial banks or securities firms. Their entire business is to, hey, I'm going to buy your stuff at auction, mark it up, and sell it off over time to the rest of the financial public because I believe there's a profit in doing so. And we want these securities firms to be able to do that because they perform this vital role, this very crucial role that's very key in a modern economy in the credit system.
And so you mentioned them, primary dealers. They hold a special position in the U.S. financial system, or at least, but they're not all U.S. banks, but they are banks that have been given the privilege and obligation of doing what with the government? They have to buy the debt, or no, they just have to put in a bid, and they can bid much higher, or much lower. They say, we don't want this, we'll take it for 50 cents. Is that right?
No, they do have to buy whatever's left over, but there are all sorts of people that are allowed to participate in the government auctions. There are indirect bidders, which are usually foreign governments and foreign overseas central banks that you want to have a whole U.S. Treasuries of all kinds because they have dollar reserve and they have reserve balances and they like to manage their reserves into investable assets. And they have other reasons as well, as we've talked about, from time to time. So these are called indirect bidders, where they place their bids through either the Federal Reserve Bank of New York or through one of the primary dealers who show up through the electronic Treasury auction process, and bid on their behalf. So there's other bidders. There's these primary dealers who bid for their own accounts, their house accounts. They're called direct bids. These banks also submit competitive bids. They submit non-competitive bids, all sorts of things that go on where this complicated auction process happens and whatever's left over out of it, the banks need to buy up because that's what gives them their primary dealer status. They have to buy what's left over at auction.
I didn't know that. So it's not primary dealers only. It's any serious accredited financial institution can buy with a non-competitive bid, and that's going to be very important in our story. And then the primary dealers are there to pick up any of the table scraps. But go ahead.
As you're saying, if you're a hedge fund or if you're substantially of sufficient size, you can sign up through, I think it's called TARP or TARPA, whatever the Treasury, the electronic auction is. And you can submit non-competitive bids in increments of $5 million.
Why don't we do that, Jeff?
Well, you could. I mean,
okay.
it's a matter of, and then look, a non-competitive bid, all it says is, I want to buy this specific Treasury security you're auctioning off. Whatever the terms are when the auction is settled, those are the terms I'll pay. So whatever the rest of the auction comes up with as a price and their yield and all that stuff, the non-competitive bids all say, we'll just buy the Treasury. We don't care what the price is, whatever the auction price is. We're reasonably sure it's not going to be something really bad or expensive. So, but we're not going to participate in the competitive side of the auction. We just want to buy paper. So there's lots of non-competitive bids that come in, and dealers bid in non-competitive bids for their own accounts, but they're limited because of what we're going to get into in a few minutes of what's going on in some of these auctions. And so there's lots of non-competitive bids that are submitted, and what's left over after the non-competitive bids, after the indirect non-competitive bids and all these other things, that's where the actual auction takes place. And it's a Dutch tender where primary dealers submit how much they'll buy at what price and all that kind of stuff. And then that's what settles out the final price of the auction.
Well, for listeners and viewers that are interested in contributing to the Eurodollar University account, we're going to open up a Patreon account. We're only accepting minimum contributions of $5 million so that we can participate in this process. Jeff, people may be wondering, non-competitive bids, why would you want to do that? You should be in the competitive. You don't want to overpay. Aha, that's when you introduce us to Solly and Paul Mozer. And can you tell us why Mozer told both Warren Buffett, the king of Omaha, what is he, the Oracle of Omaha, and the U.S. government to go stuff themselves repeatedly?
Yeah, this is in the early 1990s, so 1990 and 1991. And what he was doing on behalf of Salomon Brothers was he was sometimes bidding for 100% of what was being auctioned. Now, remember, this is back in the early 90s where yes, people were complaining about the fiscal deficit situation then, but it was nothing like it was today. But there were still billions of dollars of paper being sold. And what Paul Mozer was doing on behalf of Salomon Brothers' house account was that he was bidding for, at times, more than 100% of what was being auctioned. Now, he didn't always get 100%, but he was basically trying to get everything that was being offered by the government and leaving nothing for anybody else. And this is back in 1990, 1991, and nobody could figure out what this guy was up to because it didn't seem like there was any value in why would you want to corner the market on a Treasury auction, right? I mean, because it's a Treasury market. It's bigger than any single auction. There's really no apparent reason for him to be doing this. Now, but not only did Paul Mozer do this, after the Treasury Department caught on to what he was doing, they started to impose position limits. What they said was, okay, we see that you really want this stuff, but we got to let other people get into this auction process too. So we're going to limit you to 35% of any individual security. And after that limit, and I think they even called it the Paul Mozer rule, after that was imposed in 1990 or 1991, I can't remember exactly which year it was, the very next auction, what did he do? He overbid again. And not only did he overbid, he actually put some bids in a customer's account and overbid through a customer account. So he kept on doing this for several auctions to the point where the Treasury Department said, you're flaunting our rules right in our face. We're going to shut you down entirely. We're going to revoke Salomon Brothers' status as a primary dealer. California pension fund said, this is embarrassing. We can't be involved with a firm that will do. I mean, Salomon Brothers brought itself to the brink of ruin to the point that Warren Buffett had to come in and testify before Congress, had to smooth everything over the Treasury Department and the Federal Reserve and the OCC and all these bank regulators just to keep Salomon Brothers in business. And what nobody could figure out, except for they conducted an extensive government investigation into this thing, but they never really put two and two together. Why was Salomon Brothers doing this? And then it wasn't just Salomon Brothers.
Exactly.
What they found out is that over in mortgage bond auctions, everybody was doing this. They were overbidding, keep cooking books, putting bids into customer accounts. This auction stuff had gotten so out of hand that everybody wanted what doesn't matter what it was, mortgage bonds from whatever, GSE, government, US Treasuries. There was all sorts of dirty stuff going on in these auction processes.
And it wasn't, when you say everybody, the number you list, or at least you said it was almost everyone, so it was about 90 other Paul Mozers. Maybe we're unfairly pointing him out because it was happening everywhere. And
Well, he was
so,
what he was doing is particularly egregious, so he deserves it. But yeah, and that's not my number, by the way. That's taken directly from
mhm.
the government report. What they said was, look, we after we all this Mozer stuff and Solomon Brothers, we went looking into these auction processes, and not just U.S. Treasury auctions. We looked at agency mortgage bond auctions too, and so we under pain of perjury, we made all of these dealers tell us what they were actually doing. And it was, I think it was it 98 or 95, 93. There was, so many of these dealers that were bidding at, especially mortgage bonds auctions, had to admit that they were cooking the books and overbidding for all of this auctioned off paper. And so it was a widespread phenomenon in the early 90s that forced regulators to stop and think, okay, something's really going on here. Now, the point that I try to make is that they never really figured out what it was. They just figured, oh, this is just a bunch of auction shenanigans and we just need to clean up the auctions. They never, ever put two and two together to figure out why.
What was it? Have you put it together for us? What is 2 and 2 then?
It's on the run liquid assets that were what they were reflecting, and what the demand for them was showing. The demand, such high demand for auctioned government bonds and mortgage bonds and agency mortgage bonds, which were the best of best collateral. It spoke to the fact that the repo market was becoming this central focus for how all of modern finance got done. That's really what this was about. This was not about trying to scalp a couple pennies on an auction or even cornering the market on a specific security to initiate some kind of short squeeze or any of the number of traditional financial strategies you might hear about. It was really about getting as much repo of the best repo collateral as you could possibly get, because that would have all sorts of beneficial balance sheet and securities lending benefits, because it reflected the idea that the monetary system was changing to more toward this repo global wholesale Eurodollar system where collateral was a vital, crucial part of it, to the point that dealers all across the entire system were willing to do all sorts of shady, dirty stuff to get their hands on the best quality collateral.
And the best quality collateral is the stuff that you can sell just like that. You know what it's priced. And that means it's the on the run, which is just a fancy way of saying the most recently auctioned version, vintage of this particular maturity. And Treasury bills, I suppose we could say they're always effectively on the run because they're so short term. And we're going to turn to that next. But Jeff, before we do, I think we have an opportunity here because you have a very nice graph that shows the high bid, the median bid, and the low bid. And I think this would be a good place to make the point that bond yields don't necessarily, what is that we always say? Bond yields have nowhere to go but up. And if that was true, then we would see the high bids much higher, right? Instead of what we see is that there are people bidding very strongly to get a hold of this collateral. I'm going to pull up the graph and you help people better understand what I was trying to say.
Yeah, it's interest rates have nowhere to go but up because combination of a couple things. It's usually, number one, inflation's coming, the Fed's printed too much money. We already talked about that. And number two, something that we heard over the last couple of years in particular was the idea that there were too many treasuries. The federal government has gone too far. The primary dealer system cannot absorb all of the government debt that's been auctioned off, and therefore that's another primary factor that's going to push bond yields always through the roof, higher, 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 higher. And part of the reason was because of the auction process, right? As we stated before, what happens is the primary dealers are obligated to buy treasuries that aren't sold through non-competitive bids or to indirect bidders. And so if indirect bidders in particular, as the argument goes, these foreign institutions aren't showing up as much at auction, that falls even more onto the primary dealers and to the supposedly straining their capacities. And therefore, you would expect if they're getting stuck with these treasuries at auction that they don't really want, you would see that in the auction prices. You would see the competitive bids, the auction high at each auction process. You would expect that to go up and up and up because dealers would have to be compensated for what they don't want. That's the part that people always miss, is that yes, dealers are obligated to buy what's being sold by the government, but there's no requirement at what price. And so if it was a problem for dealers to absorb all of these treasuries, that would be reflected, because we would see dealers saying, this is too much. I don't want this. You got to pay me more to take this off your hands, government. We never see that. In fact, in some cases, as you can see, especially earlier this year, in March and April in particular, you see the auction high yields that are below the market price or the market yield in the secondary market, which are dealers saying, we want so much of this stuff, and the non-competitive bids have left us with so few, we're going to overpay. And so over the last couple of years, as we've been told that there's too much debt out there, that the government's selling too much debt, the auction prices and the way these have gone off, especially the low yields, what we've seen is that the dealers are more than happy to buy what's left over, and in some cases, they're submitting extreme levels of non-competitive bids to make sure they get more than or get as much as they can possibly get.
And Jeff, so for our audience that is listening via podcast, what we see is three different tenors: US Treasuries. We see the yield over time, and then you overlay that with three lines: the high yield, the median yield, and the low yield. And I think anyone that's watching this right now notices that the big difference here is the low yield. The high yield, the median yield, and the actual constant maturity rate that we see in our newspapers, those are all overlaid each other. Perfect. But then you point out these low yields, we see chasms. And then you point out extreme collateral shortages. Is this a useful, consistent measure for us to, because it's so hard to look into the shadows of the Eurodollar system? Is this somewhere that you turn to, and if you see the low yield really low, does that alert you that something's wrong? I don't expect to see things fixing themselves until this normalizes.
Yeah, it is an indication. It's never an indication you want to take it by itself. It's something you always want to corroborate. As we keep saying, it's whether or not this fits into what everything else is saying, and usually it does. But in this case, yes, what it's showing is that there are times when there is such strong demand for these on-the-run longer-term bonds and notes. What we must take away from that is that primary dealers are hey, I want this paper. I've submitted non-competitive bids, but I have limits I have to obey for those. So in this competitive stuff, I'm just going to, it's like bidding $1 and the price is right? It's making sure that I'm going to get as much paper as I possibly can. Whatever the position limit is in the competitive bid, I'm just going to bid down to zero to make sure that I get these treasuries in my possession. And so it's an indication. And again, this is not a huge level. I mean, the auction low yield is only 5% of competitive bids that are submitted, 5% of the accepted bids that are submitted. So it's not an overwhelming, indication of everybody's piling in and paying whatever, but it does indicate, hey, there are people out there, there are dealers out there that are willing to pay extreme low prices or extreme high prices for these high prices, low yields for these auction securities for some kind of reasons. And it's not, it's not because they're expecting something to happen with the Federal Reserve or something like that. They're doing it because there's a utility and value in their holding these papers or these securities in their house account.
Jeff, would it be fair to say that once the economy is rip-roaring again, we wouldn't be surprised to see this reverse and see the auction high yields spike above?
I don't think you will see the auction high yield spike above. That's really about demand from dealers. I think what you would see in reflation, as we saw in 2017, you see the secondary market nominal yields up, and the dealers in the auctions will normalize their behavior to what's happening in the secondary markets, because that's what dealers do, right? That's the whole point. They're saying, okay, the government wants to sell X. We think the public wants to buy that amount, but what price? And so the dealers are intermediating this primary market and the secondary market. And so they're, unless there really is a major problem in the dealer demand, they're getting too much paper they don't want to hold because they don't believe they can sell it to the public, because that's the last resort, right? If you don't have any use for the securities on your own balance sheet, then I can sell it to the public because there's people who are willing to buy it. And so if you think, okay, these treasuries are too much of a problem on my own balance sheet, I don't think I can sell them to the public, then you would expect the high yields at these auctions to creep up. to compensate dealers for getting stuck with stuff they don't want. And so when we overlay the auction prices and the auction yields with the secondary market and seeing how they're in harmony, what that says is that at the very least, if the dealers don't want the Treasury securities, they know they are absolutely perfectly assured that they can sell them to the public at a reasonable price. They don't have to worry about getting stuck with what they don't want because that's always their last resort. And so there can't be too many Treasuries. Either the public or the dealers want them. And in truth, as we see, is that the auction low yield is the dealers want these just as much as the financial public does.
Well, recently, Steve Van Meter, who you've been interviewed on Real Vision, has his own great, fantastic YouTube channel that I recommend everyone check out, Steve Van Meter. He pointed out that there was some selling taking place in what I had earlier referred to as always effectively on-the-run Treasury bills because they're so short-term, less than 1 year. And Jeff, you took a look at that, and if the audience wants to follow along, they can in an article called Just Who Is and Who Is Not Selling T-Bills. That was posted on November 25th. Jeff, what did you see? Can you walk us through what you found?
Yeah, the key word is selling, right? And I think that's what triggers people's interest. Okay, if you think, okay, remember this is tick data. So we're talking about foreign financials, foreign central banks, foreign banks, whatever, non-banks, just the foreign financial sector. And so if they're selling Treasury bills, you have to think, okay, why are they selling Treasury bills? Do they believe that, that the short end of the curve is going to rise? Is there something going on there? And that's really the idea is, okay, are we talking about foreigners selling Treasury bills, or is there something else going on in the bill market? Because as you look at the tick data, that's exactly what did happen. Whether we call it selling or not, that's what's open to interpretation. The tick data shows that in July and then again in September, both the private side as well as the official sector, the FOIs or FEMAs, whatever you want to call them, there was a significant amount of net decline in bill holdings, especially in September. I think it was about 30.3 billion net in lower in gross holdings, and that compared with July, where it was the private side of the foreign sector that had been disposing of Treasury bills in a substantial amount. So there's something going on, and you can see how that contrasts with earlier this year, especially in April, May, and June, where these same foreigners were buying Treasury bills, or at least absorbing Treasury bills, as if they couldn't get enough of them. In fact, in the month of I believe it was April, the private side of the foreign market were bought more than 100 billion in bills in a single month. So it was a massive amount of buying, and so easy correlation, right? That was the worst condition. So if they're absorbing bills, maybe that's bad things, and if they're starting to sell bills, does that mean things are getting back to normal?
And what you did is you went and you asked the Treasury, you asked Mr. Mnuchin, hey, what's going on with the vintages and the tenors that you were issuing? And that's what you show in the next graph, is that perhaps it's not so much selling as rebalancing or simply an unavailability of bills?
Yeah, and we have to keep in mind the other side of this, which is bill supply, right? In fact, the government does what the government always does. It has a handbook that it follows in emergency situations. And from time memorial, the Treasury Department has done exactly this thing. When faced and when confronted with an unexpected and unexpectedly large fiscal shortage, they absorb that deficit, that unexpected deficit, by issuing bills, the shortest term debt, because they're reasonably assured. Because bills are monetary equivalents in many places and many uses, they're reasonably sure that they can sell that debt, and they did. In fact, they didn't need the Federal Reserve's assistance either. In fact, QE6, none of it was bills. Very little of it, maybe none of it. And so
that's a very important point.
Yeah, this wasn't QE. This was the private market, and especially the foreign private market, saying, "Well, you got trillions of bills to sell. We'll take it." And so the private financial system, both domestic and foreign, easily bought up all those bills. But from the Treasury Department's perspective, that's all that's what you do. You issue the shortest term debt, and then over time, you expect, unless you're going to get a windfall of tax revenue, which we obviously know is not the case, over time you convert that short-term debt into longer-term debt, and especially if interest rates are very favorable in your direction. And that's exactly what Stephen Mnuchin at the Treasury Department did. Right at the end of June, they started to issue fewer bills and started to and began to issue more longer-term notes and bonds. And so when we're looking at this, particularly what the foreign sector might be doing with Treasury bills, we put this together what the Treasury Department is doing as far as supply, and maybe it wasn't selling in July and September and foreigners selling bills. Maybe it was just the fact that they had fewer bills to buy. So as these short-term, especially the 4-week and 8-week, which are the ones that have been reduced the most, as those have come due, they are not rolled over at the same levels that they had been in April, May, and June. So there were fewer of them for foreigners to purchase. So it wasn't necessarily that foreigners were selling bills; they just didn't have any bills to buy. And so in some ways, it was a forced rotation into other areas of the Treasury market.
Jeff, we agreed beforehand that this would be a quick, short, brief show. And I think it's our longest one we've ever done. But it flew by for me. I loved it. I have nothing further to add. Do you have anything else to share with the audience? Anything that I didn't ask you that's very important?
I don't think, hey, if there is, we'll make sure we cover it next week, because there's always enough interesting things to talk about. Even, as we look forward to maybe some more positive days ahead, we give thanks and we think about things that are good. And, despite all the things that are bad, I hope that we'll have more good things to talk about in the weeks ahead.
Very well said, Jeff. And I will talk to you next week.
All right. Take care, Emil.